Market crash prediction. Market crash prediction. All right, so let's look at we're going to look at the CAPE ratio. And a lot of people, this is a Shiller cyclically adjusted price earnings ratio, and I'm not going to get into it deep here today. But basically, everyone their moms say, have you seen the CAPE ratio? Look, it's the highest it's been since 2021, and we know what happened in 2022, and then we know what happened in 1999 was way up here. Look, bloop, bloop. And then we see 1929, bloop, bloop. Yeah, exactly. Okay. And that somehow predicts stock market declines. Okay. So anyway, we're going to go over here to this article that I was reading this morning by Jeremy Siegel. All right, this is written in 1998 as a off his book Stocks of the Long Run, which I have a couple of his editions back there, and you should get them. It's a great read. I don't know when the last updated version was, but again, the CAPE ratio, a lot of people will say it signifies, where did I have it? Oops, what happened to it? Right there. Will say signifies lofty valuations that are too high to justify the prices. That's what they're saying. Valuations are too high to justify the prices, so either one of two things happens. The prices go down to make it more reasonable in terms of valuations, or the earnings go way up to make the prices seem less frothy, if that makes sense. One of these two things got to happen, according to the people who say the valuations are too high. Prices got to go down to justify the price per earnings, or the earnings got to go up to justify the price. All right, and no one's really predicting in terms of either of those things necessarily, other than the price go down. They never predict the earnings go up. They always predict the price go down, i.e. a market crash. All right, so let me show you what we're going to read this article from Siegel here. And valuing growth stocks, revisiting the Nifty 50. The lofty levels reached by the Nifty 50 in the early 70s is often held up as an example of unwarranted speculation. But a glance in the rearview mirror indicates investors were right to predict that the growth of these firms would eventually justify their prices. Yeah, right here. And we're going to say, after the 1973 and 74 bear markets, the value of most of the Nifty 50 stocks, many investors vowed never to pay over 30 times earnings again. And again, if we look at the CAPE cyclically adjusted, you can see it's 37.53, which is the third highest it's ever been. Third highest. So that means the valuations must be too high. Is the conventional wisdom justified that the bull market of the early 70s overvalued these stocks because of their lofty valuations? Or is it possible that the investors were right to predict that the growth of these firms would eventually justify their lofty prices? Let's see here, right here. I want to go all of these right here. So the Nifty 50 were a group of premier stocks, IBM, Xerox, Polaroid, Coca-Cola, that became institutional darlings of the early 70s. All of these stocks had proven growth records, continual increases in dividends. Virtually none had cut its dividends since World War II, and high market capitalization. This last characteristic enabled institutions to load up on these stocks without significantly influencing the price of the shares. Remember, you couldn't. This is before ERISA was passed on this. So pension funds they couldn't buy small and mid-sized companies. They could only buy blue chip companies. All right, that's it. And one of the things that happened with ERISA, it allowed the pensions to be able to go into small and mid-sized companies, which actually increases huge demand for those companies as well, especially after the 73, 74 destruction. I think it's down about 44, 50% roughly in those years. So a lot of these institutional firms who previously had their hand cuffed to go in small and mid-sized companies and real estate and whatnot, now they had the ability to do so. And on top of that, the big companies just got smoked. So now they started looking at small companies, which is why we had a massive increase in small companies from basically 76 to 83. And about 76 to 83, something like that, which you have never seen again like that. Anyway, let's keep going here. Here's Forbes saying, what held the Nifty 50 up? The same thing that held up the tulip bulb prices in Holland. Popular delusions and the madness of crowds. That delusion was that these companies were so good it didn't matter what you pay for it. The inexorable growth would bail you out. Obviously, the problem was not with the companies, but with the temporary insanity of institutional money managers. It was easy to forget that probably no sizable company could possibly be worth 50 times earnings. But okay, so we're comparing stocks that actually produce things, that employ people, stuff that you buy to bubble or tulip bulbs, or may I say Bitcoin. All right, let's keep going. I find it very interesting. All right, now we're going to switch the page over right here. Many of the original Nifty 50 stocks are still giants today. This is in 1998, mind you. The Nifty 50 did sell at hefty multiples. The average price to earnings ratio of these stocks was 41.9 in 1972, more than double that of the S&P 500. Over 1/5 of these firms reported PE ratios over 50, and Polaroid was selling at 90 times earnings. And so you can see right here, here's the Nifty 50, all right? And you can see right here, the 41.9 was the PE ratio of the Nifty 50 at the end of 1972. The S&P was 18.9. So you're paying twice for $1 of earnings in the Nifty 50 than the S&P 500 as a whole. Isn't that crazy? Yes, sir, it is. All right, let's keep going here. And we're going to turn the page, like what's that guy named? Bob Seger. And we're going to go to this page right here. All right. However, after 1976, the Nifty 50 stocks became deeply undervalued, and a portfolio of these stocks purchased during this time would have substantially outperformed the S&P 500 index. The after-tax yield on a portfolio of Nifty 50 stocks purchased at their market peak would have surpassed the after-tax, the S&P 500. Do you hear that? The after-tax yield on a portfolio of Nifty 50 stocks purchased at the market peak would have surpassed the after-tax yield on the S&P 500 for an investor in or above the 28% tax category. You can see right here. Annualized return of the Nifty 50. Even though the PE was 41.9, the S&P was 18.9, the Nifty 50 stocks in a non-rebalanced portfolio, just set it and forget it. If you bought them at the market high of December 1972, averaged 12.2% a year from then until Jeremy Siegel wrote this in 1998. The S&P 500 averaged 12.7. Are you hearing me, man? Even though you purchased the stocks at 41.9 price to earnings ratio, on the market peak, you would have got 12.2% a year rate of return on the Nifty 50. The S&P 500, which had 18.9, only gave you 12.7. 50 basis points higher, but still at the end of the day, that ain't too shabby. In fact, you can see right here, this right here, here's Coca-Cola. It had a PE ratio in 1972 at 46.4. Given the annualized return from 1972 to 1998, it should have had a PE ratio of 82. Merck should have had a PE ratio of 76. Philip Morris should have had a PE ratio of 65. Pfizer should have had a PE ratio of 72. Sharing had a PE ratio of Johnson & Johnson, my son's texting me there, so I had to look at it. Johnson & Johnson had a PE ratio of 57, and Forbes said you should never pay over 50 times earnings, and yet that was warranted because they averaged 12.6% a year for the next, I don't know how many years that is, 26 years. Look at that. Crazy, man. I mean, Sharing, 48 was a PE. They should have been 79.8. Now, some of these companies, these ones, right, Polaroid had a 94.8 PE, and it averaged, it's almost like a British Petroleum, which I did a video on yesterday, is lost 1% a year going back to 1972 to 1998. So it should have only had a PE ratio of 11. Emery Air Freight, 55.3, should have only had a PE ratio of 8. And then you can see whatever this MGIC Investment Corp should have had a PE ratio of 4.8 as opposed to 68. But still, you see at the end of the day, a non-rebalance of Nifty 50 averaged 12.2. within spit distance of the S&P 500. And what Jeremy says is, what is so surprising is that many of these stocks were worth far more than even the lofty heights that investors paid for them. Investors should have paid 68.5 for Philip Morris instead of the 24. Coca-Cola is worth 82 times earnings. Merck was sported a multiple more than 76. The group that was most undervalued and subsequently most successful were the brand names. In contrast, this is very interesting. In contrast to the brand name consumer stocks, the technology stocks, that is those in the Nifty 50, failed badly. IBM was actually worth only 17 times earnings, but it was double that in 1972. Xerox was only worth 19.4 in reality, but it's about 2.5 times that in 1972. Who would have thought that in the 1970s a soft drink manufacturer would so thoroughly trounce technology giants such as IBM, Digital Equipment, Texas Instruments, Xerox, and Burroughs. Burroughs actually became Unisys in 1977. Very interesting. Let's keep going here. We're just going to read the conclusion here real quick. I thought this is very interesting here. A portfolio of Nifty 50 stocks purchased at the peak in 1972 would have nearly matched the S&P 500 over the next 26 years. Wall Street's misunderstanding led to a dramatic undervaluation of many of the large growth stocks throughout the 1980s and 1990s. Stocks with steady growth records are worth 30, 40, and sometimes more than earnings. What can investors learn from this? One is you must pay for growth stocks. All right. Actually, right here is pretty interesting. What caused the decline of the Nifty 50? There's two explanations. The first is that a mania did sweep these stocks, sending them to levels that were totally unjustified on the basis of prospective earnings. The second explanation is that on a whole, the Nifty 50 were in fact properly valued at the peak, but a loss of confidence by investors sent them to the dramatically undervalued levels, 100%. 100%. Don't pay any price, is what Siegel says. You must pay for growth. The growth stocks often sport very high multiples, but stocks that are able to consistently maintain earnings growth year over year are often worth far more than the multiple. Good growth stocks, like good wines, are often worth the price you have to pay. Don't pay any price, is what Siegel says. Among these growth stocks, those with the lower price to earnings ratios tended to outperform those with the higher ones. You know what I'm saying? Most importantly, be diversified amongst growth stocks and groups. Despite their dazzling performance, buying just a few of these growth stocks was quite dangerous, 100%. Anyway, so in this case, again, we're looking at the CAPE ratio is the S&P 500 as a whole right here. People, the earnings are too high. Maybe they're justified. Maybe the earnings, remember, the Nifty 50 were at 41.9 in 1972, excuse me. And it more than, I mean, you had 12%. That means you're doubling your money every, 7 years? Yeah, every 7, that's 12. 72 divided by 12. 72 divided by 12.2. Every 5.9 years, you're doubling your money. Is it worth it, even though the next 2 years you got smoked? Of course it was. Can I say the same thing's going to happen now? I have no clue. You have no clue. But I hear these people, I say, well, okay, well, if the CAPE ratio is such a great predictor, where was the CAPE in 1972? Oh, right there. 18. Well below where it was in 1965. Huh, interesting. Where's the CAPE in 2007? Oh, right there, 27. Well below where it was in 1996. And we had massive run-up in 1996, 7, 98, 99. So you can say the CAPE, look, was right there. Okay. CAPE was right there. Where was the CAPE? Where's the other one? I can't really think of any big, what was that? 1930, 1936, the CAPE was at 21, which is well below where we are now. I mean, you can tell me that 1966, look how high it was, Josh. That predicted is at 22. 22. Now we're at 37. If you said, I'm going to get out, and the CAPE ratio is going to buy here, you missed all these years right here. You just missed it. You missed it because, right, no one knows where we are in this. They don't know. It's going to go up or down. We just don't know. It's easy to say in hindsight, this was a predictor, but no one knows that because no one knows what the future is going to hold. Now, I find this very, very interesting. So, look, I have no clue. We just got out of a bear market last, 2022. Are we due for nothing? Man, I have no idea. All I know, these companies making money? Yes. As long as they're making money, that's all that matters. That's all that matters. Now, the technology stocks is less than that because the technology stocks ebb and flow. The consumer products, the Cokes of the world and Philip Morris and stuff. Pick up Smoke and RJ Reynolds. Remember, is RJ Reynolds even still stock? I don't know. Is RJR still a stock? Let's take a gander, shall we? We're going to gander to see if RJR. I dabbled in some RJR in the past, even though I don't smoke because I like the ladies. RJR. No, it's not. What happened with RJR? Anyway, I wouldn't sweat it too much. I mean, if you're retired or about to retire, yeah, we want to have the barbell for sure. But if you're not, I would not sweat this at all. All right, God bless. We'll see you. Love your thoughts. Smash that like button.